Welcome to the HMO Property Show by investors for investors. Brought to you by the HMO Property Co, Australia's leaders in impact investing. Investments made with the intention to generate a measurable, beneficial social or environmental impact alongside a positive financial return. Catch us weekly as we discuss all things cash flow positive property investing.
Welcome back to the HMO Property Show. I'm your host, Neil Gibb, and today I've got my good friend, superstar accountant and Perth's #1 property accountant. It's Mr. Nitin Vashisht. Nitin, welcome back to the booth.
Thanks, Matt. Always good to have a chat with you.
Always, mate. Well, we both love property, don't we? So,
yes.
And we both love saving money.
Exactly.
So it's going to be a good one. Today, I'd like to talk about tax planning. It's getting close to the end of the financial year. And anyone that's got properties that are cash flow positive, or anyone that's got business and they're making profit, should definitely consider tax planning at this time.
Absolutely, Matt. Absolutely. Neil, the tax planning is so important, and a lot of people just leave money on the table, not thinking about it. Now, Kerry Packer once very famously said to a Senate committee that anyone who doesn't legally works on reducing their taxes needs to get their heads examined.
Yes.
And I tend to agree.
Yeah.
There are a lot of opportunities out there. And when we talk of tax planning, really, we are not trying to talk about any dodgy strategies. We are just trying to play within the legal framework.
Yep.
And make use of the law smartly in our circumstances to save tax.
Yep.
And that's absolutely fair income.
Yeah. So everything's above board. We're not doing anything dodgy.
Absolutely.
Yeah. What are some of the ways that we can, before we get into tax planning, what are some of the ways we can actually reduce tax? I think we touched on them previously in the last podcast, but in case anyone's forgotten.
Yeah, all right. Look, let's first see what are the basic principles of tax planning. Now, one of the basic principles of tax planning is if you can get a tax advantage today, get it today. Don't wait to get it the next year, because the laws might change, the levels might fall.
Do they change the tax plans every year, tax laws every year?
Yeah, it can change. So if you're getting a tax advantage today, get it today.
Yeah.
Don't think that all right, it's going to be there forever and you can get it next year. No, get it today. Get it this year. Get it as soon as you can. And anything that you can defer to the next years. To the next year or the year after, defer it to as long as you legitimately can.
In case they change the rules again.
Exactly. So any advantage you can get it today, and anything that you can pay tomorrow rather than today, do that.
Absolutely. Better off in our pocket than theirs.
Absolutely. It's always, money is always better in your pocket than in ATO's pocket, mate. You're working hard to keep your money to yourself. You need to pay your legitimate share of taxes. I would agree with that. That means you're alive and kicking. I've said that before. But you don't want to pay even $1 more than you should. Yeah,
correct. I think in the last podcast as well, you said it's not about how much money you make, it's how much money you keep.
Oh, exactly. and also for a lot of people who are either running a business or they own property, or particularly cash positive property, structures can be a very important component of saving them taxes.
What structures do we have available?
I think trust is a very popular structure. Sometimes it can be a company or it can be a bucket company. But one thing, like I say with structures, Neil, it's horses for courses. We need to be able to fit them to each individual situation. Structure cannot be used like a formula that will work in every situation for everyone. Yeah.
So it's a case-by-case basis, depending on what it is.
Absolutely.
Yeah. Do we hold, I know you just said it's case-by-case, but do we generally hold property in companies, or do we hold them in trust structures?
I think property is always better in a trust structure, especially if you have to hold. And the reason for that is that when you incur a capital gain in a trust, you will get a 50% discount on capital gains, as you will get it as if it's in your own name as well, but you will not get it in a company.
Yes. pay 100% income.
Correct. And a lot of people I talk to really get carried away, you know, because they just think it's cool. A company appears to be cool, and people understand a company more than they do a trust.
Yeah.
But there's a big difference.
So people generally go with what they feel comfortable with rather than what's the best outcome.
Exactly.
Okay. So what are the things we can consider at tax time? Tax planning time, sorry. And when should we be doing it? Should we be leaving it right the last minute and calling you on June 30th and saying,
no, mate, no. You see, first thing what I say is that tax planning is about looking forward. You know, after 30th June, all I can do is lodge an accurate tax return for you. That's it. The horse has already bolted. You've already fired the bullet, and I cannot help you catch the bullet you've already fired.
Yeah.
So the best time to look for tax planning is between April, May, and even let's say the first half of June. Now, what really happens at a tax planning appointment is we would sit down and work through with the client that what is going to be their estimated income for this year. So if they have their property, have their rent increased, have their interest increased, have their salary increased, or have their business volume increased, what is new that has happened? And we work out a scenario that based on that, what will their taxes look like if we don't do anything? And from there onwards, once we agree to that, yes, this is the estimate, then we go back and come back with some scenarios that these are the strategies we can use, and these are the tax, these strategies will save you. And you need to give some time to yourself to be able to discuss that, digest that, and if it involves some cash outlay, like putting money in superannuation or making some prepayments, you need to give yourself some time to be able to organize that cash. So that is why I say that from April onwards, let's say from mid-April to mid-June is the best time to do the tax planning, not last minute. And a lot of time what I tell the clients is that don't worry about the tax return. That will happen. That will happen at the end of the year. But what we talk about and discuss in between the years is what is going to save you more tax than what happens after the close of the year.
And it's not all about just saving tax as well. If people are looking to buy property, you might need to make them look better on paper.
Correct.
For the banks.
Correct.
But at the same time, if they don't want to pay much tax, then there's also ways we can reduce taxable income.
Correct. But a lot of time also, you know, if you're making contribution to super or those type of things, I don't think that impacts the serviceability much, because the banks and a lot of lenders tend to add that back because they see it as a discretionary spend.
Yeah, okay.
Yeah.
Excellent. So what are the sort of strategies that we got then at tax time for reducing tax?
Okay, so look, let's start, because I know deal a lot in property, and especially cash positive property.
I like to dabble in it, yeah.
Now, one good thing about cash positive properties is that you are actually making money.
Yeah.
You're not trying to save tax by losing money.
True,
isn't it?
Yeah.
So, but that gives you another problem that once you're left with money, you don't want to pay a lot of tax on it. You know, it needs to be a high cash flow property, but not a high tax property.
Correct.
We want a high cash flow and low tax properties.
Yes.
So obviously that means that we need to do a little bit of planning. And for these type of things, I know you were asking earlier that what is the best time to do tax planning. So for year to year, yes, it's from mid-April to mid-June. But a lot of time when you are going into high cash flow properties, the time is before you make an offer onto the property. So for example, a trust structure can give us flexibility to be able to distribute income to your family. But if you've already put an offer in a wrong structure, it could be in the name of a company or it could be in your own name, then that flexibility really gets culled. You know, so really, if you are starting a new venture, like buying a high cash flow property or HMO property or an NDIS property, your tax planning really starts with the structure. and getting the right structure, that will maximize your asset protection, and that will also maximize or minimize your taxes.
Perfect.
So this is an important aspect for property people and business people to get their really the structure right. Superannuation, and I know we're going to be talking a little bit more about superannuation, can be a very good strategy for everyone really.
Yep.
in maximizing that. And prepayment. Now, a lot of people don't realize, and all the people who own a property listening to this podcast, I would say that they should really consider a prepayment strategy. So what really happens is that you are legitimately allowed to prepay your interest on your property or insurance on your property for next 12 months.
Right.
And claim a deduction for it.
Yep.
This year. Now imagine if someone is paying $18,000 or $20,000, and we have had clients paying $24,000 in interest.
Up over the last couple of years.
In interest,
Yeah.
and if you prepay the next year's one and get a deduction this year, so you really can save $7,000-8,000
Yeah.
in tax.
Yep.
Now, obviously, what happens is that you are only bringing forward the deduction. So it's not sort of an actual saving, you are bringing it forward. And the next year you prepay it again for the year after. So your next year onwards, your deductions will come on to a normal level. But this year, you will end up getting double the deduction. And this is what I was trying to say before, that if you can get a tax advantage today, get it today.
Yeah. In case they change
Don't
the
bloody
rules.
Don't bloody wait to get it the next year.
Yeah.
So that can have a big tax savings, and the tax, and this $7,000-8,000, let's say that you have saved, you can put it into your super and save more.
Perfect. Yes. Very good. I like it.
Isn't it?
Yeah.
So obviously, and if you really are making a lot more money through your trust structures, or if you do not have any family to distribute to, or if you have distributed to this family and there's no really room left to distribute any more amongst the family members and save tax, we can distribute to a bucket company.
For the viewers, for the listeners and the viewers, because this goes on YouTube,
Yes.
what is a bucket company? Because people ask me that question quite a lot.
Okay, so bucket company is just like your normal stock standard company,
Yep.
which you specify as a beneficiary of your trust. So if you have a trust, you are able to distribute it amongst your family members, and you are also able to distribute it to the companies that are associated with you. And bucket company is one of the company that is mentioned in the trust, that this is also one of the beneficiaries of the trust.
Perfect.
And we can distribute it to you,
Yep.
to that company. Arguably, that company doesn't do anything else and will pay tax at 30%.
Yep.
But if you distribute to any active company that's running a business, then the tax can come down to 25%.
Right. Okay.
So that's a lot better. So if you have a tax rate of more than 30%, then distributing to bucket company is a good idea.
What's the income rate for an individual to be pay more than 30% tax? Is it 120k?
Not sure. I'll have to do the
Yeah.
workings. I can't tell you offhand, but I think most people who are buying property or are able to afford HMO and those type of properties will be in that 30 plus
Yeah.
tax bracket.
Yeah. Definitely. If they can service a loan.
Correct.
For the properties that they're buying with us.
I mean, anywhere I would say people earning over $120,000 and $150,000 will be in that tax bracket.
Definitely. So we can distribute from the trust that we hold in the property into family members or children, brothers, sisters,
Correct.
mothers,
Correct.
parents.
Correct. Now, obviously, there are some anti-avoidance provisions called 100A, Section 100A. The ATO has tightened about. So you need to be careful how you do that. So one of the things is that distribution cannot be a paper distribution as was happening till now.
Actually distribute
You've got
the money.
to actually distribute the money
Yeah.
to that person, and that person and that money cannot find its way back to you directly or indirectly.
Right. Okay.
So there are still legitimate avenues for tax planning in that, but I would highly recommend that talk to your accountant and then take a decision how you can use that.
Yeah. Okay. What are the sort of tax effective structures do we have that we can, or what we can distribute to, apart from a bucket company? Is there any more?
No, I think the bucket company and your family members.
Yep.
You see, this is how this flexibility of trust can reduce the tax for you. That you have flexibility to distribute income or stream income to people around you in your family who are at a lower tax bracket.
Yeah.
And bucket company can be one such structure a trust can distribute to.
And it pays 30% tax on the income that's distributed to that bucket company.
Correct.
Yep. Can we get the money back out of the bucket
If
company?
you get the money back out, then you're in the same situation that you will have to pay tax at your rate.
Okay.
Then you don't get any tax savings, but you need to be able to use the bucket company to drive investments from there.
Right.
So let's say you distributed 50,000 or 100,000 to a bucket company, then you need to use that money to make investments through the bucket company.
Right. How do we do that?
Or just buy shares or maybe do property development or other things, you know.
Can we use the money in the bucket company to go to another entity?
Correct. I mean, you can. What you can do is, if you are doing a property investment through a unit trust, then that 100,000 you distributed to the bucket company can go towards buying units in that unit trust.
Perfect. And that way, it's still not trading as such, because you said the bucket
Correct.
company doesn't really do anything risky. Is that right?
It shouldn't. It
Yeah.
should. It shouldn't. I mean, with a lot of those things, Neil, it's not the question of whether you should do it or you should not do it, or is it allowed or it is not allowed. Obviously, it is allowed and you can do it. The question that needs to be asked is will it be a smart thing to do? So normally, if you are holding an important asset or a bit of a money, then you don't need to be taking risk and asset holding in the same entity. You need to be able to split the risk from asset holding.
Yep. Okay.
So that will be a smart thing to do. But are you able to put both of them together? Of course, you are allowed to put fuel with fire. But is it a smart thing to do is the question you need to ask yourself.
Yeah, true. What other strategies do we have at tax time? What about if we've got some underperforming properties and we want to get rid of them and then invest it in some that produces more cash flow? Is there a way we can reduce capital gain tax?
Absolutely. Absolutely. Now, this type of strategy is perhaps a lot easier decided and implemented in case of shares. That if you have some shares that are dead and you don't see much value, quickly sell them off. You probably will make a loss, but you have made capital gains on other shares and you can set it off, you know. But obviously, property is a bit of a bigger beast, you know.
Slow moving.
It's a bit slow. It's a bit slow moving.
Yep.
Now, let me answer your questions this way. A lot of people I deal with think that the property is something now they have and they will hold it for 30 years, 50 years and everything will come right. But we know that when you are playing, when you are banking on time to sort things out for you, you probably are speculating, you know. So you need to be able to make a smart decision, you know, and if something, even if a property is not really working for you and is giving you grief, there's no point sticking with it. And there's no point hoping, 10 years time, I probably would be laughing. You know, you're just speculating, you're dreaming, isn't it?
Yeah. A lot of people get so emotionally attached to properties.
Emotionally attached to property. I was having a chat with someone the other day. They wanted some guidance onto the property, and you see, and I was saying, don't get emotionally attached to the property. Don't let. It's just like anything else. When you are investing in shares, you invest in shares that will give you the best return on investment, that will give you the best capital gains, isn't it?
Yes.
You don't invest in shares thinking I might one day be able to transfer those shares to my kids.
True.
Isn't it? And you invest, and you don't invest in a company that is closest to your house. That company could be in United States, but as long as it stacks up, and investment-wise, you invest in that. Yes. But most people will have their comfort zone looking for, especially the first time people, is that they will look for it within 5 kilometers of where they live, but we can go, we can touch, we can feel, we can see it's still standing, we can shift in there, we can pass it on to our kids. No. Treat it as a business venture. And look at return on investments, what it can deliver to you, and do not make an emotional decision out of it. Unfortunately, return on investment and emotions, they don't go well together.
You've got another really good quote, which I always think about. Your investment decision should not be driven by your tax.
Should not be driven by your tax strategy. And a lot of people say, I want to invest in, and this is the first, when people come to me, this is the first thing I ask, why do you want to invest in property? Or we will get some tax back. No, wrong reason. First you will have to make a loss, not a good strategy. And you are letting your tax strategy guide your investment strategy. And if you're doing it for the first time, and if you do not have much experience in there, talk to people like you who can help and guide. At least you'll be in good hands, and you'll make money rather than learning from your own mistakes.
Absolutely. Standing on the shoulder of the giants, they call it, don't they? Why got to make your own mistakes when you can learn from other people's?
Absolutely.
In the early days, we made lots of mistakes, and that's everybody's benefit now because we don't make them anymore.
Absolutely, mate. Absolutely.
What about repairs and maintenance to existing properties that people might have? Is it worth spending money on that, and is it tax deductible?
Okay, so first of all, I always tell people don't spend money for the sake of spending money, and don't spend money just for getting a tax deduction. So if the property doesn't need the repairs or renovations, don't do it. Don't do it. But if it does, then it, from a timing point of view, it is best around this time you do it, because you get the return on that pretty quick. You don't have to wait 12 months or 18 months to get the return back in terms of tax. So that's a good time to do it. And obviously don't do it in July, because then you will have to wait 18 months to get some return.
Yeah. Do it early.
Return on it. So pick your time around this time, around the tax time. So that's really a good thing, because whatever the repair or renovation will cost you, it will help have some tax advantage for you. So your net cost will be less.
Yep.
And the difference between repair and it's a big confusion in a lot of people. What is repair and what is renovation? And from a tax point of view, there's a big difference, because if it is repair, you will get 100% deduction. But if it is a renovation, then you get a depreciation on it over a few years.
Yep.
So you won't be getting 100% back.
Yeah. So is putting a new carpet down a repair, or is that maintenance?
It depends. If you're just changing the floor or doing this thing, simple thing, and the floor was damaged and you decide it all needs to be done and you put a carpet in there, that's repair. If it is a part of your whole renovation you're doing, then it's a different thing. And a lot of time the distinction between them can be slim and grey.
Yep. Exactly. So how do we decipher the difference between them? And do we back up this with photographic evidence for tax time?
You need to have some evidence. I mean, an invoice should be sufficient.
Yep.
If you have photographic evidence, well and good.
Yep.
But what I say is, if you really are doing renovations, then keep all your invoices and your evidence, and if you have photographs, even better in there to be able to substantiate that in case there is a question from ATO.
I had Bradley Beer from BMT on the podcast a couple of weeks ago. A really, really insightful podcast. What do you do with the QS reports that they provide you with?
Look, first of all, I encourage everyone to have a QS report.
Yeah.
Now, I was glad that you did that podcast with Bradley, because a lot of people do not know about the QS report and why they should do that. Now, you have no idea how many tax returns I had to revise the last 2 years tax returns because people had an investment property and depreciation wasn't claimed. Or the depreciation was claimed, but was claimed by their previous accountant and it looked low. And when we got the QS report done, their depreciation was almost double.
Right.
And you get a lot more.
Even money on the table.
Absolutely, you are leaving money on the table. I mean, what does a QS report cost? Between I think $450 to $700.
But
You'll get it back within the first year, mate.
Absolutely.
So
Especially
literally,
a
what
brand
we
new
do
one.
is, what does that QS report does is it gives us the depreciation tables for the next 40 years, in terms of what should be the depreciation on the building, and what should be the depreciation on the plant and equipment in there. And that really helps. And also, in case of an ATO audit, once you show them the quantity survey report, and this is how you have taken the depreciation, it's been done by an independent quantity surveyor, the matter ends there.
Yeah, perfect. The new budget came out. I don't know whether it came out or whether it got released as in ready to be implemented, but in there they were saying that the depreciation rules are going to be changing. So from 40 years, they're going to bring it down to 25 years.
Yeah, but I think they're bringing it down only for build to rent model,
Right.
which means that you have to have 30 to 40 apartments or townhouses or things like that,
Right.
which you have to hold it for 10 years and things like that. So from what I have seen is it probably won't apply to mom and dad.
Right.
The way you can see.
Won't affect the single dwellings,
No.
just the big end of town.
Because it's built to rent model, and what is built to rent model is something that you have to have a bigger developments
Right.
there. So what probably I would have much preferred. It would have been applicable to mom and dad,
Yeah, it
and
would
I
have been
think,
incredible.
and I think that would have gone down a long way to help with the rental crisis, rather than give it to the top end of the town developers.
Yeah.
But look, it is what it is.
Yeah, and their projects take forever to get out of the ground anyway, and then
Yeah.
they need to build 40, 50 apartments. It's
Correct.
not exactly a one-year thing, is
Correct.
it? What about contributions to super? What can we do in there?
Yes, very important. I think the first thing we need to understand about the contribution to super is that you will need to make an outlay to super, which you cannot touch it till you are 60 or 65.
Locked up.
So it's locked up.
Yeah.
Now, that's not really a bad thing because you are contributing to your savings, but everyone's circumstances is different. So, but if you need a bit of a cash flow now outside super, then that's not a good idea. But if you are someone who is in late 40s or early 50s or not far away from retiring or transition to retirement, then you will be able to lay your money. But what I also say, Neil, is that if you really are a property investor and if you are onto high cash flow investing, you can invest in those properties from your superannuation, from a self-managed super.
Yes.
So where you'll be paying only 15% tax. I mean, we were talking about how structures can help you save tax. I mean, superannuation is a structure where you pay only 15% tax, and once you are 65, you pay zero tax.
Yep.
I mean, imagine you could be making $1 million profit
Yep.
on your capital gains, selling your property, and you pay zero tax.
Yes.
Not $500,000.
Yep.
So that can be exciting. So you need to have, I think it's best to have it in your planning to contribute to super.
Yep.
If you are a property investor, you can beef up the amount in your super, and once you hit a critical mass of 250,000 in your self-managed super, then you can consider investing in property through a self-managed super.
Yep.
And way that works is, now there are 3 ways you can take advantage of super. Now every year you can contribute up to $27,500 to your super. So let's say you are earning $200,000 and you are short on that, so you still have $7,000-8,000 left in that, using that limit. So you can contribute that either as a salary sacrifice or as a personal contribution to super to top that up. So you get a deduction for that. Second good thing is that you are allowed to use carry forward super contributions for the past 5 years.
What does that mean?
So what that means is that this $27,500 limit, or whatever the yearly limit, because it was $25,000 few years back, if you were not contributing up to that limit, then that means is it is not gone. You can still catch up on that within a 5-year rolling period. Now, I was just doing tax planning with a client earlier this week, and guess how much of those carry forward contributions they had?
5 years?
$82,000.
So you put $82,000 in there and pay 15% tax on that.
Correct. You pay 15% tax in that, and if you are the person who happens to be on 47%, you've saved nearly 32% tax.
Yeah, it reduces taxable income by $82,000.
Isn't it?
Wow.
That's huge.
Huge.
And if you happen to be 58 or 60, you will be able to get that money back as a transition to retirement. And if you happen to be having a money in your superannuation and you are 60 or 60 something, you are able to withdraw that money from your super as a transition to retirement already, and then contribute back. So carry forward the super contributions. A lot of people are not aware. They think, if you didn't contribute to those limits in the past, then it's gone. No, it's not gone. You can contribute up to your $27,500 limit, and super spouse contributions. So if your spouse is not earning that much and is earning $37,000 or less, or is a homemaker, then you can contribute $3,000 to your spouse super, and ATO will give you a tax rebate of $540.
Wow, that's good.
Yeah.
Very good.
It's good, isn't it?
Yeah. So plenty of ways that we can look at minimising tax, but it also means that we need to be speaking with a specialist like yourself who knows all these
correct.
loopholes.
And one of the things what I want to clarify is salary sacrifice. Salary sacrifice or novated lease can be a very good way to save tax. But let me just first clarify this word salary sacrifice, because it is a very confusing word. That as if you are sacrificing something to get. You are not sacrificing anything. You are just sort of repackaging your pay. So if you are getting a pay package of $200,000, all you are doing is telling your employer that, all right, can you please pay us $180,000 in cash or the bank transfers as you normally do, and other $20,000 you can give us a car worth that $20,000, or that $20,000 you can transfer it to our superannuation. So you are basically sacrificing the cash component, but on the other side you are gaining a benefit component, and so this benefit component comes from your after-tax salary. So you save tax on the one side, but your employer will have to pay a fringe benefit tax on that as per the fringe benefit tax rules. Now, the whole thing in terms of this salary sacrifice, whether it works for you or it doesn't work for you, is that the fringe benefit tax, if your savings in income tax is a lot more than the fringe benefit tax that you have to pay, because the chances are your employer will also recover that fringe benefit tax cost from you. So if your saving in income tax is more than the fringe benefit you have to pay, and it can legitimately be in many cases, and there are ways and means to reduce that fringe benefit tax, then salary sacrifice works for you.
So it's a win-win.
It's a win-win. But if the fringe benefit tax is going to be much more than the income tax it saves you, then it doesn't work for you.
How is FBT calculated? Is there a way that...
There's a separate rules. It's a separate rule, but if you have to just use a rule of thumb, like I said, 20,000 is the benefit. Let's say a car. I'm just taking a very rough thing. So FPT could be somewhere around between $9,000 to $11,000.
Well,
on that.
On a $20,000 car. It's up there, isn't it?
But you can make some contributions toward that. So there are ways and means, So definitely talk to your employer in the payroll department, whether they allow you salary sacrifice, and definitely talk to your accountant.
Great. Good stuff. What other stuff can we claim in the way of receipts that we should be keeping? What if we work for ourselves or we work from home? Can we claim anything for that?
Or definitely, if you really work from home, Neil, you are able to claim some expenses for your home office or your electricity and other things. But the tax office wants you to keep a proper log so that if they ask that we should be able to substantiate that this is my log, this is my diary, I'm working 2 hours a week or 1 hour every day on these things from home. Now you can use either the actual method, that can be actually a pain and be very subjective, or you can use some standard cents that ATO allows, that so many cents, 72 cents or 85 cents, whatever that figure is per hour, and you claim that, Yeah,
cool. And I'm guessing they'll have some sort of template diary on their website you can download and fill out if you want to take that.
You can download that and fill out, but with all these things, you need to be able to substantiate to ATO. The requirement for a diary is not as onerous as that of a logbook in case of a car.
Next question,
is in case of a car, but you need to be able to still substantiate.
Yeah. So what do we need to do for a car then if we use our car for work and a little bit personal?
So if you are using a car, basically, like I said before, is if you're using your car for personal use, then there is an element of fringe benefit there. So you need to maintain a logbook for about 3 months, 12 weeks, detailing where you went, how many kilometers, whether it was for business use or personal use. And then as long as you have a high business use, you should be okay. But your personal use portion, fringe benefit will have to be worked out. And you can say that, all right, this is the fringe benefit is coming, this is the cost coming for personal use, and here's the money, I'm reimbursing the company for the cost of my personal use, and then you're all right.
How detailed does the logbook need to be? Is it,
or you get you can get buy a logbook from post office and maintain it, and you get these days apps.
Yeah, we've got a cool one called Driver's Note.
Yeah, or you can do it in Excel.
Yeah, good old spreadsheet.
Yeah.
Instant asset write-off for new or second-hand assets. What's all that about?
That's been done away with.
It's been done away with?
In this budget.
Right, there you
so
go.
30 June is the last date.
Right.
So what happens with instant asset write-off is, let's say you bought a car worth $50,000, you will be able to write it off immediately. So now that has been done away. With 13 June, it was temporary anyway, but I would have much preferred for it to remain. And from 1st July, it's been replaced with a $20,000 write-off.
No matter how much the asset.
How much the assets, so you can write off $20,000 or immediately, but if it is more than $20,000, if you are a business person, you can put it as a part of a small business pool and simplified depreciation rules, or you can claim a normal depreciation on the things. But this full expensing, so if you have some big expenditure coming and you have some big amount of tax, and if you need to buy some stuff, buy that stuff before 30th of June.
Speak to your accountant first.
Speak to your accountant first, but just don't buy anything just for saving tax.
Yeah, that's it. Is there anything that we should have touched on, Nitin, that we haven't touched on yet?
Yes, I think one of the things what I want to say, and there's a lot of confusion, especially for property people, is on at what point capital gains tax is triggered. A lot of people think that it is triggered on settlement. It is not triggered on settlement. It is triggered when your offer and acceptance goes unconditional. That's when it is triggered.
There you go.
Usually it will mean that when your finance comes through, that's when it is triggered.
Yeah.
So what that really means is a lot of people think, and I've had cases where the people have planned that, okay, my settlement is going through this year, and they have planned it that I will pay tax on this year. My income is less this year, so not a problem. So that is fine. But their offer and acceptance went unconditional before June. So ATO wants their tax in the previous year, not in the next year.
There you go.
And if your income appears to be very high in that year, then you will be caught by surprise. So keep this. I mean, there are small subtleties and all that, and this is why I encourage people that before you are buying or selling or taking an important decision, please talk to your accountant. Because then the ability of your accountant to help you is going to be far greater than breaking the bad news to you at the time of tax.
So, for instance, I send a lot of emails to your wife, Anju, I'm going to do this. Is this right? Anju, I'm thinking about doing this. Is this right?
Absolutely, mate. Absolutely.
Yeah.
I mean, this is why you need to work with your accountants and have your A team right.
Absolutely.
Yeah.
Have you got any examples, Nitin, of any sort of tax planning that you've done for somebody?
Yes, I've just got this latest one I did for a client next week. I've obviously taken out all the client names and everything, so I'll just talk more in general terms. Now, this is a client that's earning a bit more than $200,000.
Yeah.
Has a couple of investment properties, 50-50
Yeah.
with a partner.
In their own name?
In their own name. But for some reason they are negatively geared, so that's fine. That's fine. So now what we discuss with the client is obviously prepayment of interest. So the client had about $13,500 interest. Now, mind you, it might look a little bit low, but that's only 50% because the property is held 50-50. With the partner 50-50. So that can be prepaid in advance. That will save a fair bit of tax for her. So that will save how much tax? That will save $5,500 in tax.
Beautiful. Obviously, we need the cash flow to be able to prepay this as well, don't we? So if you
correct, that is why you need to be talking in advance. She will need to talk to the bank as well, because if you are on a fixed interest rate and the bank doesn't allow that, then it will not work.
Right. Okay.
So this is a little bit one thing, keep in mind, when going in with the property and financing, talk to your brokers, so if you will have that flexibility. And then unused super caps. She had about $42,000 worth of unused super cap. Now that's another save $17,000 in tax. Sorry, now salary sacrifice you can do, that will another save fair bit of tax. Another thing what I normally need is income protection insurance. Now, insurance is something, it never fails to intrigue me that when you ask people that you have an insurance, they say yes, how much you are paying, say we don't know. And when it comes to life insurances and income protection insurances, a lot of people don't know. They think they don't have it. The chances are that 99% of people will have it in this super fund. Both of them, life insurance and income protection insurance. And the cover might or might not be adequate, but that's a discussion for another time. But if you have your income protection insurance in your superannuation fund, then you're only getting a 15% deduction.
Okay.
So it is best to get that cancelled or consider that and get it in your own name. And then you will get a much higher deduction. Obviously, you need to think that in your superannuation fund, you might be getting a better rate. You need to weigh up with a higher deduction. And if you really shop around, you probably can get a good rate as well outside super. So it's a good idea to get or consider having income protection insurance outside your superannuation if you can afford that cash flow. So for this client, just with these strategies, we saved total about $26,000
in tax. Cool. Nice outcome.
Now what will happen is some of them the cash flow will permit and you can find the cash flow, but for others, if you can't find it this year, you can still do it next year, or at least you have a plan in there. Now that's a money that was being left on the table without being even aware of.
Yep. So would that come back as a $26,000 tax rebate?
Or it will come in terms of less tax, and you will get a refund. So I'll just tell you. So from a net $12,000 you will have to pay. I mean, that is after PAYG.
Yeah.
So after PAYG, you'll have, instead of paying $12,000, you're getting a $14,000 tax back.
Beautiful. Always nice getting 14 grand back from the tax man.
So absolutely. So you don't you need to plan for these things, and it certainly is possible. And then if you really look at some other scenarios, if people who have HMOs and high cash flow properties, and if you have it in a structure, you are able to distribute it amongst your family members and straight away reduce tax.
Beautiful. Plenty of information in that podcast for everybody. Nitin, thank you very much for coming in. I think the big things from there are set yourself up right from the start.
Absolutely.
Set your trusts up, get yourself market ready before you're buying any properties.
Absolutely, Mike.
And connect with your expert in your A team, March, April, very latest, like mid.
Look, worst come to worst, what will happen is that there won't be any tax savings for you. But more than likely, you'll find that you are leaving some money on the table.
And like
that is a lot better than trying to fudge some deductions to get a tax advantage, you know, and that's not a good idea.
Nah, definitely not. And like Kerry Packer said, anyone that doesn't try and legally minimize the tax.
Absolutely. I actually have another quote for you, and it's on my social media. It's actually a quote from Einstein, which says that understanding taxes is so hard. So I don't blame people. You know, if Einstein couldn't understand taxes.
Do you think they make it complex on purpose so that no one can understand it?
No, I think everyone is trying. There are a lot of creative people out there who are trying to find ways to avoid tax. So it's a cat and mouse game, I think. But yes, look, taxes are very complex. You know, I'm glad they're complex because that keeps me in job.
Absolutely. What I'm going to do, Nitin, I'm going to put your Calendly link in the podcast note on the YouTube page. If anyone has any questions, just click the link, book it in Nitin's calendar.
Sure, mate, sure.
And happy to have a chat.
Happy to have, and if someone is coming from that link, I'm happy to have that initial chat and put them in the right direction. And see, you know, if there are any savings or if there are any gaps, you know, that we can help them plug.
Perfect. Nitin Vashisht, thank you very much for coming on the podcast.
Good stuff, mate. Thanks a lot.
Thank you.
Enjoyed it.
Thanks for listening. Make sure you tune in the same time next week so you stay up to date with all the cash flow positive property updates.